Hello students, I welcome you all to e-learning platform of Kadi Sarva Vishwavidyalaya. In this video we will discuss about monetary policy. According to Johnson, monetary policy is a policy employing central bank's control of the supply of money as an instrument for achieving the objectives of general economic policy. According to G.K. Shaw, any conscious action undertaken by the monetary authorities to change the quantity, availability, or cost of money. In general, monetary policy refers to the credit control measures adopted by the central bank of a country, or we can say it's a policy implemented by central bank in our country, Reserve Bank of India, to control the money supply to achieve certain objectives. So now we will discuss about what are the objectives of monetary policy. Number one is full employment. Second one is price stability. Third one is economic growth, balance of payment. So these are some important objectives of monetary policy. Now, to control the money supply, Reserve Bank of India or a central bank use two types of tools. One is called quantitative tools, another one is called qualitative tools. Here we will discuss both. But before that, blood circulation is play very important role in our human body. Like that, monetary supply is like a blood circulation in the economy, and it should be under control. If money supply is high or more in the economy, it creates or results in inflation. If money supply is low in the economy, it creates recession. It becomes the cause of recession. So that's why it is very much important to control the money supply in the economy. And for that, Reserve Bank of India implement monetary policy, and here we will discuss quantitative tools of monetary policy. Number one is bank rate. Bank rate is the rate at which the central bank lends money to the commercial banks for their liquidity requirements. As we know, bank is a financial institute which borrow money from the common people or the citizens, do the finance and earn interest. So, bank sometimes borrow money from the Reserve Bank of India. So here, bank rate is the rate at which central bank lends money to the commercial bank for their liquidity requirements. Bank rate is also called discount rate. In other words, bank rate is the rate at which the central bank rediscount eligible papers like approved securities, bills of exchange, commercial papers, etc. held by the commercial bank. And bank rate is important because it is the pace setter to the other market rates of the interest. So bank rates have been changed several times by RBI to control inflation and the recession. So it's a very important tools of monetary policy, and it's a part of quantitative tools. Now the second one is CRR. It's a short form, cash reserve ratio. So cash reserve ratio is an effective instrument of credit control. Under the RBI Act of 1934, every commercial bank has to keep certain minimum cash reserve with RBI. RBI is empowered to vary the CRR between 3% to 20%. A high CRR reduces the cash for lending and low CRR increase the cash for lending with the bank. So CRR has been brought down from 15% in 1991 to 7.5% in May 2001. It further reduced to 5.5% in December 2001. So RBI vary the rate of CRR to control the money supply. We had discussed about CRR. Now the next one is SLR, Statutory Liquidity Ratio. Under SLR, the government has imposed an obligation to the bank to maintain a certain ratio to its total deposit with RBI in the form of liquid assets like cash, gold and other securities. So RBI has power to fix SLR in the range can be increased maximum up to 40%. Okay. So this is the SLR, Statutory Liquidity Ratio. Repo rate and the reverse repo rate. In determining interest rate trends, the repo and reverse repo rate are becoming important. Repo means sell and purchase agreement. Repo is a swap deal involving the immediate sale of securities and simultaneous purchase of those securities at a future date at a predetermined price. Repo rate helps commercial bank to acquire funds from RBI by selling securities and also agreeing to purchase at a later rate. On other hand, reverse repo rate is the rate that bank get from the RBI for parking their short-term access fund with RBI. So this way, repo rate and reverse repo operation are used by RBI in its LAF, it means Liquidity Adjustment Facility. So RBI contracts credit by increasing the repo and reverse repo rate, and by decreasing them it expands credit. So this way, repo rate and reverse repo rate are important quantitative tools of monetary policy to control the money supply. Then next one is open market operation. It refers to buying and selling of government securities in open market in order to expand or contract the amount of money in the banking system. The technique is superior to bank rate policy. Purchases injects money into the banking system, while sale of securities do the opposite. It means it decrease the money with the commercial bank. During last 2 decades, the RBI has been undertaking switch operation. This involves the purchase of one loan against the sale of another or vice versa. This policy aims at preventing unrestricted increase in the liquidity. So these are the quantitative tools of monetary policy. Now we will discuss qualitative tools of monetary policy. As we know, quantitative, it means we can measure it in number, and qualitative, we can't measure it. Sometimes they are known as selective measures. Selective measures. Let's start. Number 1 is ceiling on credit. The ceiling on level of credit restricts the lending capacity of a bank to grant advance against certain controlled securities. So, it's an important function of monetary policy. Here the important part is it restricts the lending capacity of bank. With the help of this, Reserve Bank of India restrict the bank to give a credit to the common people. Then margin requirements. A loan is sanctioned against collateral security. Margin means the proportion of the value of security against which loan is not given. Margin against particular security is reduced or increased in order to encourage or to discourage the flow of credit to a particular sector. It varies from 20 to 80% for agriculture commodities. It is as high as 75%. Higher the margin, lesser will be the loan sanction. The third one is discriminatory interest rate. Through discriminating interest rate, RBI makes credit flow to certain priority or weaker sector by charging concessional rate of interest. For example, sometimes government give a concessional rate to a specific sector to promote that sector, like infrastructure or the loan for the resident, people who have no home, to provide the shelter facilities. RBI issues supplementary instruction regarding granting of additional credit against sensitive commodities, issues of guarantee, making advances, etc. Directives. The RBI issues directives to bank regarding advances. Directives are regarding the purpose for which loans may or may not be given. And another one is direct action. It is to serve and is therefore rarely followed. It may involve refusal by RBI to risk discount bill or concessional of license if the bank has failed to comply with the directive of RBI. Then government use this type of action. And the last one is moral suasion. Under moral suasion, RBI issues periodical letters to bank to exercise control over credit in general or advise against particular commodities. So these are quantitative and qualitative tools of monetary policy to control the money supply to achieve objectives like full employment, then price stability, balance of payment and economic growth. Thank you very much.